Welcome to This Explainer. Okay, so right now, millions of people are celebrating a huge milestone. They just deposited their first $10,000 into a standard big bank savings account. They're thinking, awesome, my cash is safe, it's working for me. But behind the scenes, there's a silent financial meltdown happening to their net worth. The truth is, the bank is absolutely running circles around you. $1. Yeah, you heard me right. If you deposit $10,000 into a standard savings account at the national average rate of 0.01%, one single dollar is exactly what your money will earn over an entire year. That is the cold, hard reality of modern traditional banking. Section 1. The brutal math of savings. Okay, let's dive into this. Because we really need to look past those warm, fuzzy bank commercials and see what is actually happening to your money day in and day out. Let's break down that $1 of annual profit. Earning $1 a year on 10 grand mathematically breaks down to roughly 8 cents a month. That is less than a third of a single cent per day. I mean, think about that for a second. You literally cannot even buy a single piece of chewing gum with what your $10,000 generates in a full year at these giant institutions. It's just a completely pathetic return on your hard-earned money. But it actually gets much worse, because while your bank is graciously handing you a crisp $1 bill at the end of 12 months, something else is draining your wealth in the background. Sure, you earned $1, but at a modest inflation rate of 2.5% to 3%, you effectively lost $250 to $300 in purchasing power over that exact same year. Inflation is this invisible force. It means your $10,000 requires an extra $250 to $300 just to buy the exact same amount of groceries, gas, and rent next year as it does today. By doing absolutely nothing and just leaving your money in that 0.01% account, you didn't protect your savings at all. Your digital balance sheet might still proudly display $10,000, but its real-world value, it is burning away every single minute. Section 2. The bank's dirty secret. So a skeptical mind should be asking a very important question right now. If your money isn't making you any return, why does the bank want it so badly? Why on earth do they spend billions of dollars on advertising, stadium sponsorships, and those sleek mobile apps just to get your deposits? Well, the answer is that your $10,000 is their ultimate leverage. The moment you deposit that money, the bank doesn't just lock it in a dark, secure vault with your name on a little sticky note. No way. Thanks to modern banking systems, they immediately take your cash and deploy it. They lend it out to someone else before you even log out of your banking app. And this brilliantly illustrates the massive arbitrage or risk-free profit happening with your money right now. The bank pays you 0.01% for the privilege of holding your money. Then they turn around and lend it out for a mortgage at 6.5%, or maybe an auto loan at 7.5%, or even worse, they lend it out to someone carrying credit card debt at a staggering 22% to 24% interest rate. They are paying you one single dollar a year just to make hundreds or even thousands of dollars a year off that exact same cash. You are absorbing 100% of the risk of keeping your money in the fiat financial system, while the bank is pocketing 99.9% of the profit. It is a profound injustice, honestly. It's one of the most profitable, entirely legal wealth transfers in human history. And the crazy part? Its entire business model relies on everyday people just staying passive and uninformed. So, what's the alternative? Let's just take a breath here. Because once you see the math, you really can't unsee it. Do you panic and stuff your cash under a mattress? Absolutely not. There is a simple, immediate solution. Section 3. The high-yield alternative. This is the simplest, most frictionless way to stop the bleeding and actually get paid what your capital is worth in the modern market. I want to be entirely clear here. A high-yield savings account, or HYSA, is not some magical get-rich-quick scheme. Structurally, it is the exact same thing as your current savings setup. It's federally insured up to $250,000. It's completely liquid, meaning you can withdraw your money at any time, and there's zero stock market risk. It's just a safe harbor. The only real difference is the interest rate. While the old-school legacy banks are stubbornly stuck at that 0.01%, reputable online high-yield banks consistently offer significantly higher rates depending on the Federal Reserve. We're talking about institutions like Marcus by Goldman Sachs, Ally, Capital One, or SoFi. They frequently offer rates hovering anywhere between 4% and 5%. Let's rerun our $10,000 experiment at a conservative 4.5% interest rate. Instead of earning $1 a year, your $10,000 now earns $450 a year. You did no extra work, you took on zero extra risk. You simply changed the routing and account number where your money sleeps at night. Just like that, your lazy cash went from barely affording a stick of gum to completely covering a utility bill or a tank of gas every single month. Section 4, the 3-step strategy. Now that we know the tool, we need a blueprint. Here is the exact actionable plan to allocate your money safely and efficiently so it works for you without ever leaving you stranded in a pinch. So the crucial point is implementing this 3-step strategy. This right here is your map to victory. The 3-month rule, automating the transition, and utilizing the overflow valve. Let's break these down. Step 1 is the 3-month rule. You need to calculate your bare minimum living expenses. We're talking rent, food, gas, insurance, and keep exactly 3 months of that amount safely in the high-yield account. For example, if your monthly survival expenses are $3,000, keep $9,000 parked right here. It is safe, it's earning a solid return, and most importantly, you can access it in minutes for a sudden medical bill or, say, if your car breaks down. Step 2 is automation. Listen, do not rely on your own willpower to manually transfer money every month. You'll forget, or worse, you'll spend it. Go into your payroll portal at work and set up your paycheck to automatically split. Have 90% go to your standard checking account for your daily bills, and have that remaining 10% drop directly into your new high-yield account. If you don't see it in your daily checking, it completely removes the temptation to spend it. Finally, step 3, the overflow valve. This is a critical mindset shift. Savings accounts are for peace of mind. They are not for long-term wealth building. Once your high-yield account hits your target emergency goal, like that $10,000 mark we talked about, every single dollar over that amount must be redirected. That overflow needs to go into low-cost index funds or retirement accounts, where it can compound and truly outpace inflation over the decades. Traditional big banks rely heavily on your busy schedule. They basically count on the fact that you're too tired after work to open a new account. They make billions off your complacency. It's time to break the cycle. Take 20 minutes this weekend, look at what your current bank is actually paying you, and move your money to an institution that respects the effort it took for you to save it. Ask yourself, are you going to keep letting your bank profit off your hard work, or are you ready to finally make your money work for you?